Hey everybody, welcome to Mortgage Today for Thursday, August 31st, 2023, and oh, what a day it was. MBS started out the day pretty much flat. It was up 3 basis points on the first hour. Stocks were again flat in the morning. Bonds were just barely stronger in the overnight session and were predictably confused by the balance of this morning's data. We got jobless claims, which came in at 228,000 on a 235 forecast. It was 232,000 previously. Then we got the Challenger layoffs, which showed that about 75,000 people were laid off in the month of August on an expectation of 23,700. Hiring plans are the lowest since 2016. Then we got the core PCE inflation, which came in at 0.2 versus a 0.2 estimate on the month over month. It was 0.2 previously, so pretty much flat there. But the core PCE inflation year over year came in at 4.2 on a 4.2 forecast, which is up from 4.1 previously. On one hand, the 0.2 core inflation is welcome validation of the similar message seen 2 weeks ago with the CPI. On the other hand, a jobless claims number in the 220s does little, if anything, to suggest the sort of labor market cooling that would precipitate a shift in the Fed rate discussion. Personal incomes rose 0.2% in July, while spending rose 0.8%. So pretty much we're getting just enough jobs growth to pay for the minimum monthly payment on the ever-expanding credit card debt pile. The PCE price index, the Fed's preferred measure of inflation, rose 0.2 month over month and 3.3 year over year. Excluding food and energy, the index rose 0.2% month over month and 4.2 year over year. So sorry, I guess I misspoke earlier. That is the headline inflation that was up 4.2. The year over year numbers are an uptick from June. However, that month was unusually low. Bonds are positive despite the increase in the afternoon. We also got the Atlanta Fed Chairman Raphael Bostic, who said that the Fed should probably hold tight and not continue rate hikes in a speech overnight in South Africa. Home prices set a new high according to the Black Knight Home Price Index. Prices rose 2.3% on a year-over-year annual basis, according to the index. Some of this is due to seasonal factors, and prices should start showing bigger year-over-year increases. That said, affordability issues will probably cap growth rates. This morning's economic data came out slightly stronger than expected on balance, and bonds rallied anyway. Granted, the core PCE was 0.2 versus 0.2, but excluding housing, core PCE was higher for the second straight month, and the annual tally remains way too high and very flat. Add in the lower jobless claims number and a beat in the Chicago PMI if you want, and the most logical reaction would have been to sell. In the market's defense, shorter-term rates did sell, but not too much. One is forced to conclude that the month-end trading distorted the day, or that it's a fair amount of belief in the whisper number that the NFP was going to come in lower than forecast due to labor strikes tomorrow. We'd expect that such a whisper numbers do not matter in a world where the NFP routinely surprises by 100,000 plus, and where whispers are a 30 to 40,000 delta. MBS closed the day up 9 basis points, not much, but at least it's on the positive side. Stocks are flat. Again, we closed the day right around that Fibonacci R1 retracement at 98.716. In global news, China's largest property developer, Country Garden, posted a $7 billion loss in the first half of the year and issued a warning of a potential default. The company has already missed payments on multiple bond issues and is currently in the grace period, while some believe the situation will remain contained like the 2008 subprime crisis. That was contained. The magnitude of Country Garden's losses is comparable to Lehman Brothers' collapse in 2008. Despite China's relatively closed economy, it's unrealistic to expect no impact on the West if the world's second largest economy faces a real estate bubble burst. Real estate contributes around 30% of China's GDP, much higher than the 16% in the US and 12% in Japan. If China's real estate share aligns with global norms, it could lead to significant GDP contraction similar to the 15% drop the US GDP saw during the Great Depression. We also got news. Lennar Homes, one of the nation's largest developers, is developing a tiny house community comprised of 350 square foot homes in San Antonio, Texas, known as Elm Trails. Each tiny home boasts a 1 bedroom, 1 bathroom, and starting at $130,000. Will this be the norm of the future?